After years of US market dominance, are global equities reclaiming the spotlight? Hi, I'm Lundén from Wellington Management. In this video, we'll explore what's fueling the recent momentum in non-US equities, especially the resurgence of value over growth, how we filter through the noise and position the Vanguard International Core Stock Fund. What we're seeing outside the US is a more regionally differentiated backdrop than investors had grown accustomed to over much of the last decade. Rather than one broad global narrative driving returns, performance has become much more sensitive to local macro conditions, fiscal policy, domestic demand trends, and market starting points. In Europe and Japan especially, more domestic value-oriented parts of the market have begun to benefit from a combination of improving nominal growth, fiscal support, and shifting policy dynamics. In Europe, that has supported domestically oriented businesses and helped drive a rotation away from international growth franchises and towards domestic value, particularly where earnings expectations and valuations have started from more reasonable levels. In Japan, a stronger reflationary backdrop, rising wages, corporate reform, and the prospect of further rate normalization have all been supportive of more domestic, cyclical, and financially geared areas of the market. At the same time, that leadership has not been universal across non-US equities. Some of the more globally exposed and growth-oriented segments of the markets have been less advantaged, particularly where a significant amount of optimism was already reflected in valuations. So the recent improvement in non-US equities is not simply a story of international markets broadly catching up to the US. It's really a story of dispersion, returning to the opportunity set with local policy, domestic exposure, and valuation discipline mattering more again. We think that kind of environment is especially favorable for an active bottom-up approach because it creates more scope to distinguish between the parts of the market that are benefiting from durable change and those that are simply moving with sentiment or short-term macro noise. This is where Wellington's research ecosystem becomes especially valuable. We're not relying on a single lens to interpret fast-moving markets, and that matters a great deal in periods like this, when headlines can be loud, correlations can shift quickly, and the market can sometimes overreact before fundamentals have really changed. Instead, we bring together quantitative signals, bottom-up fundamental research, macro inputs, and a breadth of ownership across the platform. That gives us a much more robust way to pressure test whether a move in the market is simply short-term noise or whether it's pointed to something more durable and investable over the longer term. The process is deliberately multidisciplinary because in environments like this, no single framework is enough on its own. What is particularly powerful is that each part of the ecosystem is answering a slightly different question. The quantitative work helps us stay systematic and disciplined about where we spend time and can often help us avoid being pulled too far by emotion or recent price action. The fundamental research helps us judge whether the earnings power, competitive position, and management behavior of a business are actually changing in a meaningful way. Macro research helps us understand whether the backdrop is reinforcing or undermining the thesis, and whether a market move is being driven by something cyclical, policy-related, or more structural. ESG can provide another layer of insight, particularly when governance, capital allocation, or incentive structures may affect the durability of the opportunity in ways the market is not fully appreciating yet. We also think breadth of ownership across Wellington is an important and often underappreciated part of the process. When ideas being supported not only by strong quant signal and positive analyst conviction, but also by thoughtful ownership across relevant teams in the firm, that can be a very useful indicator that the opportunity is real and the conviction is broad rather than isolated. It's not about following consensus for its own sake. It's about using the broader platform as another way to test the quality and resilience of an idea before we express it in the portfolio. Just as importantly, all of those insights are filtered through portfolio construction and risk management. We do not simply identify attractive ideas and stop there. Every trade is evaluated in the context of the overall portfolio, with pre-trade tools helping us understand the marginal impact on risk, factor balance, and diversification. That discipline helps us avoid compounding mistakes in uncertain periods and ensures that even when we do lean into an opportunity, we do so in a way that keeps the portfolio resilient and broadly balanced. So when markets are digesting geopolitical shocks or shifting macro conditions, our objective is not to react to every headline. It is to use the breadth of Wellington's research platform to slow the process down, separate signals from noise, and decide whether the new information changes the long-term investment case. In some cases, that gives us the confidence to stay with an idea through volatility. In other cases, it tells us the backdrop has changed enough that we should trim, exit, or reallocate capital elsewhere. We think that ability to combine breadth of insight with disciplined implementation is one of the clearest advantages of the process. Coming into 2026, the portfolio was positioned to lean into areas where macro, fundamentals, and the team's alpha signal were aligning, while fading exposures where upside had become less differentiated or where crowding had built up. That has remained the basic pattern through the year. One of the clearest areas of conviction has been domestic Japan and selected emerging Asia. In practice, that has included adds or new positions in Japan Airlines, Pan Pacific, ASICS, CATL, and AIA. In healthcare and pharma, conviction has also been rising. The team has added to names such as GSK, Galderma, and Apollo Hospitals, reflecting a view that valuations are more attractive, pipelines and fundamentals are improving, and the sector offers useful diversification. Within financials, the team has been selective rather than simply adding broad bank exposure. That has meant targeted additions in names like KBC, Resona, Saudi National Bank, and Power Finance, where earnings yield, domestic growth, or infrastructure-linked upside looked attractive. In Europe, the team has remained measured and opportunistic. It has added where the risk-reward looks better, for example, Accor and Total, while trimming our existing holdings where the thesis looked more fully reflected or conviction had cooled. Where the team has been fading exposure is in names where conviction weakened or the thesis deteriorated. Examples include exiting or reducing HDFC on governance concerns, SAP as we evaluate AI's impact on their business. The team has also been deliberately trimming momentum-heavy and more crowded exposures to keep the portfolio balanced. That has included reductions in Samsung, SK Hynix, Barrick, Engie, and Equinor, where strong performance or crowding had made them larger contributors to risk than desired. So the overarching message is continuous portfolio upgrade. The team is leaning further into names where conviction is strengthening and recycling capital away from positions that have become crowded, less differentiated, or less attractive on a risk-adjusted basis.